everyone, today we are going to discuss about classification and type of cost presented by Valerie Dayun Anasami, Ayu Ajay Natasha, Siti Haja, Muhammad Iqbal Fitri and Muhammad Faizuan bin Muhammad Zaidi. Okay, now we're going to the fourth type of cost. Firstly is controllability. Controllability means that cost may or may not be influenced by the decision or action of a manager. Second one is behaviors, which means measure how the total amount of the cost changes as the level of business activity changes. The third type of cost is traceability, means cost for which there is a direct cause and effect relationship with a process, product, customer, geographical area or other cost objects. And lastly is normality, means costs incurred for a certain level of activities that may or may not have been planned. Okay, now we're going to move on to controllability. Controllability can be classified into two categories. Controllability cost means that costs that can be influenced and monitored by an authorized manager. For example, compensation or retrenchment salary. Generally speaking, all direct costs including direct material, direct labor and some of the overhead expenses are controllable by lower level of management. Now we go to uncontrollability costs. Uncontrollability costs means that costs that cannot be influenced and monitored by an authorized manager. Most of the fixed costs are uncontrollable. For example, rent of the building, managerial salaries, increase in the tax rate, or increase in fuel price, which object to government policies. Okay, let's move on. Behaviors costs can be divided into the following categories. Firstly is fixed costs. Fixed costs are those that will not change over a given range of activity and period of time. These costs will incur even if no units are produced. A fixed cost is a cost that does not vary in the short term irrespective of change in production or sales level or another measures of activity. For example, the rent on a building will not change until the lease runs out or is renegotiated. Example of other fixed costs are insurance, depreciation, and property tax. The second behavior cost is variable cost. Variable costs change in direct proportion to the level of production. This means that the total variable cost increases when more units are produced and decreases when fewer units are produced. It has its method of calculation of profit. The profit is determined by deducting the total fixed cost from the contribution margin. The contribution margin is ascertained by deducting the total variable cost from sales. For instance, salesman commission. The third one is mixed cost. Mixed costs or semi-variable costs have properties of both fixed and variable costs due to the presence of both variable and fixed component in them. An example of mixed cost is telephone expense, because it usually consists of a fixed component such as line rent and fixed subscription charge, as well as variable cost charged per minute cost. And the last behavior cost is step cost. Step cost is costs that are fixed over a range of activity and then rise to a new level as activity level changes. As example, depreciation of machinery will increase as the company purchases more new machines due to increase in the level of production volume. Thus, the depreciation expenses will increase too. Now we move on to traceability. If the cost object goes away, then the traceable costs associated with it should also disappear. The traceable cost is important because it is an expense that can reliably assign to a cost object when constructing an income statement, showing the financial result of the cost object. There is a traceable cost in an expense management tool. For example, a company is planning to eliminate an entire product line and wants to understand which expenses will be terminated when the product line is shut down. The costs traceable to the product line include advertising expenses, a marketing specialist, a production line, and a warehouse. All of these costs will be eliminated. And the last type of cost is normality. On this basis can be classified into two categories, which is normal cost and abnormal cost. Normal cost is a cost that has been planned for a certain level of activities. It is cost which normally incur in the condition in which this output level is normally achieved at a particular level of output. These costs are unavoidable and predictable. It is a part of the cost of production, for example, loss due to evaporation. And the second basis is abnormal cost. Abnormal cost is the cost that has not been planned for a certain level of activities. It is the cost which is not normally incurred in a condition in which this output level is normally achieved at a particular level of output. This cost is avoidable and is not part of cost of production and charged to costing profit and loss account, for example loss of production due to machine breakdown. Okay, that's all from us. Thank you for watching this video. Remember, surround yourself with assets, not liabilities. Thank you.